Hello and welcome back to this video. So today we'll be looking at what is synthetic indices trading. Synthetic indices are digitally generated financial instruments that mimic the price movement of a real world market using algorithm rather than being tied to actual assets like stock or currencies. As we all know, the normal currency pair markets actually mimic real world movement. Let's take for instance, if you indulge in any forex exchange, like if I want to travel from Nigeria to maybe United States or any European country and I exchange my Nigerian naira to that country's currency, I've influenced the movements of a currency pair which we trade in forex. But unlike that, in synthetic indices, there is no actual real world movement. When I say that, I mean that there is never a real world activities that influence the movement of synthetic indices. Rather, this market has been programmed to mimic or to copy the behavior of normal forex markets. They are essentially visual markets where price fluctuations are controlled by predefined mathematical model, not by external factors like news or economic events. So just like I said before, synthetic indices is not influenced by any real world activities like maybe governments, US governments changing a policy which will either crash the value of dollar or increase it. But unlike that, there is no real world activities that influence the movement of synthetic indices. Rather, any synthetic indices instrument that you are trading has already been programmed using a predefined mathematical model. That means that some people have come together and analyzed the real movement, like they have analyzed the movements of forex over a decade and said that this is the particular behavior of the movements of real world assets like currency pair, stock, or commodity. So using those analysis and the data they got, they now programmed another instrument which we call synthetic indices to mimic or copy the real movements of normal assets like currency pair or commodities. So that is synthetic indices for you. So let's look at some of the characteristics of synthetic indices. The first one here is that it is algorithmically driven. That means that synthetic indices rely on complex algorithms to generate price movement, simulating volatility and trend. So what can we learn from this statement? It means that synthetic indices, the volatility of synthetic indices is algorithmically driven, not that it is being influenced by real world activities like maybe you buying another currency with your own local currency or a government releasing a news that might influence the value of their own currency. Rather, this has already been programmed with algorithm. So once you can study the structure of this market over time, you can easily predict its movement because it's not dependent on external factor. So let's move to the next one, which tells us that synthetic indices is not tied to a real asset. Unlike currency pair, which is tied to a real asset, they don't represent actual stock, currency, or commodity, but rather acts as a representation of those markets. So these synthetic indices has been programmed to mimic. When we say mimic, it means copying. It means emulating the movement of other markets. So this particular market, which we call synthetic indices, has been programmed to be emulating the real movement of other assets like currency pair, but they are not influenced really by activities happening out there. So let's move to the next one, which is controlled trading environment. This means that traders can experience volatility and price action similar to real world markets, but without the influence of external news or events. So when you are trading synthetic indices, you will also experience volatility just like you experience volatility when you are trading currency pair. But this one is not influenced by external news. One of the major challenges with trading currency pair, which is influenced by normal market news, is that after your technical analysis, those rules of trading like entry point, support and resistance could be broken when there is a release of news in the market, and this can be frustrating sometimes. So when you are trading synthetic indices, you cannot experience those type of things. So the next characteristics or an advantage of synthetic indices is that it allows you 24/7 trading. So synthetic indices are available for trading around the clock, unlike traditional markets with limited trading hours. Normally, you can't trade currency pair on weekends, but if you are a type that does 9 to 5 job, you may want to be trading on weekends. So synthetic indices is the best option for you because you can trade synthetic indices even on weekend. So, and these are the major characteristics of synthetic indices and a brief explanation of what synthetic indices is. In case you have any question, just leave it in the comment section below. I'll do my best to attend to it. So see you in the next video.